As the lights of festivities sparkle across the country, we are celebrating a quarter century of Samvats here at CNBC TV18 as we turn 25. Here's wishing everyone a very happy Diwali.
And what a prosperous one it's been, a 30% rise in the Nifty alone with SIP inflows at record highs. But just as we take our break from our hectic routines, the festivities give us a moment to pause and reflect. It seems like the markets too are shifting into a lower gear.
Absolutely. The question, of course, is this just a speed bump, a slowdown, or maybe even a chance to step in? After a long euphoric run, questions are emerging before we bring in our star-studded Samvat Baitak, as we're calling it, to answer and debate all these questions. Let me actually quickly put some perspective and some points on the table. First up, while starting valuations have been pretty high, we have been seeing earnings downgrades at the same time across the board. The MSCI India index is currently trading at 24 times forward earnings. That's at a level we've only seen twice in the recent history, 2007, 2021. Both times, the markets were riding high, but we all remember the corrections that followed. Relative to other emerging markets as well, in the region, MSCI India is also running at a significant premium. The current PE premium is 70%, a steep jump from the 5-year average, which is 55%. This is some investors wondering if the market's recent exuberance has gone a bit too far too fast. We've also had a weak first quarter and an ongoing Q2. Analysts are asking if H2 recovery will materialize. A lot depends on this festive season. Let's get to flows. Domestic mutual funds have been stepping in to prop up the markets. They've bought nearly $10 billion month to date, effectively countering the $10 billion sold by FIIs. Now, starting cash balances at mutual funds were about $17–18 billion. Add to that the monthly inflows into equity schemes, which has been around $4 billion. But there's a massive pipeline of equity issuance, IPOs and whatnot. The question many are asking is, if FII selling continues, will mutual funds run out of dry powder soon? And of course, we can't ignore the bigger global backdrop, the outcome of upcoming US elections combined with the impact of ongoing global conflicts. These are still unknown, but they are looming. There are also some questions being raised by veteran US investors about how certain really we should be that the Fed's big interest rate cutting cycle will indeed materialize. Well, you're with us here on the Diwali Market Movers Forum, and we are in conversation with some of the top experts. Lots of questions, as we just told you. Let's welcome Naren, boss man at ICICI Pro AMC, and Nilesh Shah, boss at Kotak Asset Management Company. They're both here. Gentlemen, please join us on stage. Thank you so much. Wishing both of you a very happy Diwali. Thank you so much for being here with us here at CNBC TV18.
Wish all the viewers of CNBC TV18 a very happy and a prosperous Diwali.
Wish all the viewers and all of you happy Diwali.
Thank you very much. Naren, let me start with you, because you've been for the longest time sort of calling for a bit of a sort of tempering of expectations, and the run that we've had in markets. We've finally gotten that at the margin a little bit. Are you satisfied or not yet?
No, it's not a question of satisfaction. I don't think we want investors to lose money because markets come down. That's not the case. See, basically what worries us, we are managing public money. So our job is to temper expectations. And that too, when you've had long periods where markets have not fallen, there are so many investors who believe that equity is like FD. And then, that worries us a lot. So that's why I think it's our job actually to temper expectations, particularly when expectations are going up and when markets are going up. See, particularly after March 2023, what happened was most investors wanted to only invest in equity and not invest in debt. And therefore, what happened was this cycle became more and more positive towards equity. And we could see over the last 3 to 6 months that first the challenge is that there is nothing wrong with India's fundamentals or something. So it is basically a valuation problem and a sentiment problem. That the sentiment problem is you have all these SME IPOs, you don't know what they have internally, and you have a situation where companies whose balance sheets are weak, managing to raise money, any amount of money in the equity market, that worries us. But we can't predict markets, so it's our job to
Let me
temper
clarify when I say satisfied, I did not mean that. I just said that is it enough tempering of expectations, or you think it's going to be an ongoing thing?
See, if for example, markets had already become a level where, things had become cheap, we would we would move out of our call to keep on talking asset allocation and multi-asset and all that and move to equity. It has still not happened. Because if you look at where markets are or look at even 1 year returns in small cap, mid cap or large cap, it is not low, it is still high. Maybe the markets have corrected in the last 1 month. But they have not. If you take the 1 year returns, they are still high and the valuations are not cheap in any sense of the word. So that's why it's still not in a situation where you can come and tell people invest aggressively at this point of time. That phase is not yet started.
Nilesh bhai, you and your team have also been sort of ringing the caution bell for a while. I remember, I think you were also one of the early ones. Are we in a bit of a corrective phase which is likely to last a little bit? What's your sense?
So I wish I knew about the market like that. Otherwise, I would have said 1 month back only that now market will correct.
Right.
We know where the valuation is. Is it cheap? Is it expensive? Markets is like pendulum, kabhi idhar, kabhi udhar. So I have no idea where markets will go. But I know now valuations have corrected in many cases. And it's time to look at stock on a bottom-up basis.
So we started the month with about $16-17 billion of cash across the mutual fund industry. At Kotak, have you already deployed quite a bit of the cash?
So we never took cash call and we communicated that to our investor. We believe my partners are taking asset allocation call for their client. If I try to second guess them, then we'll end up having, wrong sequence. There are funds like multi-asset allocation fund or a balance advantage fund or asset allocation fund where we have taken allocation call between debt, equity and gold, silver. There is some marginal increase in equity allocation from, let's say, gold or fixed income. But that's marginal. It's not material movement.
Well, Naren, just to build on to the point that you made about FDs versus equities, right? For the last couple of years, it wasn't even an option. But going by the euphoria in the system, by the valuations as well, would you not rule out that, say, in the next 12 to around 24 months, actually a fixed income could outperform a mid or small cap fund? Could that be a possibility? Because the index itself has moved up by 3 to 5 times in the last few years.
It could be a possibility, but if you ask an average investor, the average investor is still very pro-equity at this point of time.
Right.
See, because you're not, you have to look at a 10-year history.
Indeed.
All the way from 2014, there has not been a down year. So, if you ask a typical investor, the typical investor is today not interested in debt or fixed income. The typical investor today is interested in equity. While we believe it is quite possible that FD can outperform small and mid cap, most investors today are really happy with equity as an asset class.
Indeed.
And that is the reality at this point of time. The challenge is, if you add a fundamental problem and valuations being high, it would be very easy for you to say that this would happen.
Right.
Today, you don't have a fundamental problem. You have a valuation and sentiment problem. And valuation and a sentiment problem is something that you can have situation where valuations can be high for a long period of time.
Indeed.
That doesn't mean that we are going to thump the table and say, put all your money in equity, because our goal is we manage public money. We don't manage our money. So our goal is to reduce investor expectation and try to get people to moderate their expectation and try to get people to invest in all asset classes and not take only risk. Because when they lose money, they tend to think that we are responsible for the losses. We are not responsible for the losses.
Right.
We are responsible. If people give us money in small cap, we'll invest in small cap. If they give money in mid cap, they will invest in mid cap. So our goal is to reduce investor expectation. Are valuations cheap today? I think barring banks where the valuations are reasonable, most other sectors are still not cheap. that we can give a positive.
So from a 5 to 10 year perspective, obviously equity is in the way, but maybe in the near term, fixed income could outperform just in the near term going by the valuations. Just one
There
more.
is one fixed income
Yes.
instruments which will outperform small and mid cap. The 50-year strip, if you can lay a hand on it. The 50-year strip will have 50-year duration, and if interest rate comes down by 0.5%, it will give you 25% return.
Wow.
So one fixed income instrument I'm quite confident will outperform small and mid
Why is
cap
it difficult to get your hands on?
because it's difficult.
But it's available?
It's available, but it's difficult to get because the long bonds are all with insurance and pension players. They don't sell in the market. But theoretically, in Indian market, we have a fixed income instrument which will outperform small and mid cap over next 12, 18 months.
Interesting.
Interesting. All right. Naren, just one more point, I think you're not attributing this nervousness more to a fundamental problem or the economy is slowing down. It's more the euphoria that's built up in the system. That's the bigger problem, it seems.
So you had a euphoria, you have some amount of euphoria, and top of it you had fair amount of IPOs. So you had a situation where the fundraisings had started to accelerate. So you have a situation, on top of it you had a situation where the FIs wanted to sell India to invest in China. So the combination of the three has resulted in it. It is actually, if you look at it, the biggest reason is what China did. That Chinese stimulus, the FIs were caught underinvested in China in a very big way.
Right.
They thought that China is a place where they don't need to invest for the next 5 to 10 years. And their valuation, if you looked at purely from a valuation point of view, China was at 9 PE.
Right.
But the problem was people were saying, no, we don't want to invest in China because China has deep structural problems. But when the stimulus was announced, most of the hedge funds, most of the foreign funds, they were caught napping, and they found India is the best place where valuation was high. They could sell the market. They could even execute their sell trades. Maybe in some of the other markets, they couldn't have executed sell trades. So they went and executed the sell trade.
Okay. All right, Nilesh, let me get you in on this. The domestic flows have been rock solid, and this equity cult has been built in India. And a lot of us are part of that. Could you tell us, according to your estimates or your analysis, how much of this FI selling is done? Because the broad outlook was $12 to $50 billion could be the readjustment that could take place because China has come back to life. Do you think the FI selling bulk of it is done? And also the domestic flows, they've shown the fatal now, which is very, very heartening. But how do you see that shape up?
So let me first contradict this statement that people are overexposed to equity. As per RBI's data of Indian financial sector allocation of Indian household, between FY21 and FY23, total money which came into mutual fund was 4 lakh crore. Total money which went into capital market, including bonds, debentures and equities direct, was 2 lakh crore.
Okay.
So, कुल मिला के 6 lakh crore आया. The increase in currency in circulation was 9 lakh crore.
So, yeah.
9 lakh crore is in currency notes. I haven't got that money in equity yet.
Right.
93% savings of Indian when they invest in financial sector is negative real return or marginally positive real return. Where do you go and put money? Bank deposits, insurance, pension, currency notes and small savings.
Right.
You want to secure financial freedom, but you are only putting 7% of your money in real return product. 93% wealth does not create any return for you. How will you become wealthy?
Indeed. There's a huge scope for penetration here in India.
So in the domestic market, there is huge scope for penetration of real return product. It could be equity, it could be performing credit, it could be alternate.
Yeah.
And all those things will come over a period of time.
Mutual fund sahi hai.
Mutual fund sahi hai because this is one product where manufacturer, distributor and investor interest are aligned.
Yep.
So the
In some industry, it's tilted towards manufacturer and distributor. In some industry, it is tilted towards investor. But this is the only industry where everything is aligned together.
Yeah.
Right.
Now coming to China, how many investors would like to invest in a country where you don't know where their ex-defense minister and foreign minister are? Today we have no idea where China's defense minister and foreign minister is disappeared. How many people would like to invest in a country where last 10 years earnings growth in terms of CSI 300 index EPS is 10%? In renminbi terms, 1% a year. In the same time period, India's Nifty went up by 166% in EPS in rupee terms.
Right, from 400.
So on a price to earning basis, yes, India looks expensive,
For a reason.
obviously. And on a price to earnings growth, we are looking far more cheaper.
Yeah. No, absolutely. And maybe because we kind of, there's a little bit of adjustment which is happening, and that's okay.
ठीक है, सुबह का बोला शाम को घर लौट आएगा, कहाँ जाएगा?
That's a nice way to put it. You're a Naren, close watcher of macros, right? First of all, do you have any views on this? How much is tactically shifted? Is it mostly the bulk of it is done?
You know, people can say that they know when FIs will stop selling.
We don't know.
FIs is not one broad single group.
Correct.
There are hedge funds who wake up in the morning, short India, evening wake up and buy India. So these things no one knows actually.
Okay. What's the big dominating global stories? Because you're a close watcher of the macro cycle as well. What's going to be important to watch, in your opinion?
Clearly the US election. And we don't know what policies will be followed depending on who comes after the US election. It will have some impact. So if the real challenge at this point of time is India has had fantastic macro. So if you look at the most important indicator being current account deficit, then you look at fiscal deficit, particularly central government and inflation. We have managed to keep it very stable. That's why Indian 10-year, the Indian government yields haven't gone up in the last 3 to 5 years. But look at the US situation. It is quite possible that after the US election, all of them will increase the US fiscal deficit. Then what happens to US yields? In fact, US 10-year yields have been going up. US 30-year yields have been going up. So what is going to be the macroeconomic impact of the US election? That is something, you know, surprisingly 10, 15 days before the US election, there's very little discussion on that, and it may have fair amount of macroeconomic implications on India. It's possible that the FIS sold India just to keep some cash for the uncertainty to deal with the US election. We wouldn't know it, and it may come back after the US election if they realize that there is no negative impact on emerging markets. Maybe that is the reason. That is clearly one clear thing. Second is geopolitical. We have seen 2 wars. Virtually the second is also like a war only if you see what's going on. Can that escalate after the US election? Because has the US government tried to persuade Israel not to escalate it ahead of the US election? We don't know that. So that is another important issue because oil has been very well behaved. If oil spikes up substantially, it has negative macroeconomic implication. That is the second, if you look at it. The third, I think SEBI has been correctly pointing out that the entire enthusiasm for the derivative market, which is there among local investors, is the third big macroeconomic thing. While the Indian government has managed macro very well, the extent of enthusiasm shown by the investors in the derivative market is a bit of a worry for the regulator. I think last week one of the members in television mentioned it has become a national pastime and it should not be. I think that is a real worry.
That has been addressed now, right? With the last...
it doesn't get addressed.
The weekly contracts, etc.
If the amount of activity still remains high...
we will know once all these changes take effect, which is on the 20th of November.
Place, but even today, as we speak, how did the quantum of selling get absorbed? A lot of it has been absorbed by the derivative traders in India at this point of time. If you look at the open interest in, you know, the entire people talk about how SIPs will save the Indian market, but the level of SIPs is much smaller than the amount of leverage which exists in the derivative markets in India. So I would say that is the third worry. So these would be the 3 things that really worry me at this point of time.
Naren, give us a couple of themes. When in your introductory remarks, you mentioned about banks. That could be a sector that at least is reasonably valued, the large private sector banks, which haven't really run away in the last few years. Would that be a sector that you'll be reasonably optimistic on? On the broader markets, you're sounding a little bit cautious, with good reason. But would banks be a theme that you would look to play?
Certainly, because what has happened is that FIs in their index had a very low weightage to banks, because one of the big component of the bank was not even in the benchmark in a big way. That got addressed partially in August, it will get partially addressed in November. So once the November change in weightage happens, in their benchmark, the weightage of banks have gone up substantially. One of the biggest problems was somewhere in the last 4-5 years back, instead of buying Indian consumer stocks, I think the foreign institutional investors bought banks. And they got very over-invested in banks. By the time the November change in benchmark happens, they would be no longer over-invested in banks. So the reason why banks didn't do well was not because of fundamental reasons, but because FIs kept selling banks. So I think that issue should be over by November. And after that, we don't have this worry that FIs are very over-invested banks. So I think that makes it much easier at this point of time. You have valuation comfort. You no longer have over-ownership of FIs. You don't have over-ownership of locals. So, and you have good fundamentals, reasonable governance. So I think that's a sector to look at this point of time.
All right, Nilesh, you come in now, in terms of sectors and themes that you think will look up from here on, give and take everything, valuations, earnings, ownership. What are the couple of sectors?
So one, quality over momentum. Now your definition of quality and my definition of quality can differ, but by and large what you consider quality. Second, high floating stock, market discovered prices over concentrated holding. ये भाई का stock, वो भाई का stock, वो भाई के पास ही रहने दो. तीसरा, reasonable valuation over expensive valuation. If you see by and large banks, IT, pharma, telecom, auto, cement, these are the sectors where you will see some stocks which are reasonably valued. Capital goods, defense, railway, consumer durable, these are the sectors where you will generally find stocks are a little bit aggressively valued. And then there is one market where you don't go because you don't understand the micro caps, the mini caps, the SME index. I believe in that market some stocks have fallen, almost 40-50 stocks have fallen quite sharply. But despite that correction, I still think it's risky to venture over there. So focus on quality over momentum, high floating stock over low floating stock, and reasonable valuation over expensive valuation.
Nilesh, I wanted your view on this consumption theme that, the commentary that's come in HUL, Nestle, Tata Consumer, all of them are sounding very, very cautious. And the numbers that came in from the two-wheeler majors, Bajaj Auto as well as TVS Motor, both of them disappointed. How concerning is that?
So one, as we speak, festival season is picked up. And in this 40 days between Dussehra to Diwali to Christmas, almost 40% of two-wheeler sales happen. What we have heard on the street, volumes have picked up, but so has the discount. If you want to buy car or a two-wheeler, today is the best time to buy because you will get all the good terms. Undoubtedly, there has been some slowdown in economy, cement sales, auto sales, petrol, diesel sales. These numbers have come subdued and soft. Is it because there was Shraddh period? Is it because there was rains? Is it because government didn't spend during election cycle? Or is there something else?
Yeah.
We'll have to really observe this festival season. If consumption bounces back in this festival season, then chances are that the momentum will be carried forward as monsoon has been good. Kharif crop and Rabi crop both should be bumper this year. So you have to be careful, you have to observe data. But in the consumption side, please remember that the consumption is now coming at the Gen Z and millennial level. Many of these established companies are banking upon their brand to get the customer. But the new customers might be moving to some other brand.
There's a disaggregation also happening.
I mean, if you go to a retail store, it's no longer necessary to buy a global MNC company's Cadbury or chocolate. You can get as good quality chocolate at half the price from a local manufacturer. People are becoming value conscious. as Maruti Suzuki advertisement said, कितना देती है? वो अगर आप नहीं देंगे तो consumer आपके पास नहीं आएगा.
Naren, on the slowdown bit, you're not so sure, right? That there's a
See, first was there are festivals which got postponed. Then you have to look at the fact that this year we had a much better monsoon. So August, September was certainly affected by monsoon. So when you have a very good rains, the activity level in August, September gets affected. So I'm not very sure whether the slowdown bit. I actually think, I really worry that this big equity boom, people are investing more in equities rather than spending in anything else.
we were just having that conversation with Ramdevji and Navneet earlier, and they were saying exactly the same thing, saying that SIP will not stop, even if you stop reduce consumption somewhere else.
And भाई मुझे तो आपकी जेब में जो पैसा पड़ा है, आपके घर पे जो पैसा पड़ा है, वो म्यूचुअल फंड में लाना है.
But you think
4 lakh crore, how can it be a big amount? Currency in circulation is double that of. And last time आपने कभी पैसे को छुआ था? You are working on your credit card or mobile phone.
But there's a lot more to come. Yeah, please.
But you look at any IPO today, there's an IPO which closed yesterday.
$30 billion.
I think look at the amount of money. So you're saying money is not there, but look at the amount of money that came into that IPO. So I feel, somewhere what has happened, it is delayed monsoon, some of the festivals getting delayed, and too much enthusiasm for stock market is also delaying expenditure. People are saying, let me keep
Delayed gratification.
Delayed gratification.
I can give one example. Nigel, am I allowed? And this is on national television. It's already happened. Our good friend and co-host here, we were having a discussion on diamonds. And Nigel has said that I will never buy diamonds. I would rather put that money in SIPs. So,
Nilesh bhai, I'm practicing whatever we talk.
Absolutely.
Yeah? I don't put 12
The diamond curve is like this, market curve is like this. So,
but talking about that, and what about asset allocation? Gold has done very well. In the last 1 year, everyone's talking about the equity market being up 25%. Gold is up as much, I think 22%.
silver has outperformed Bitcoin
Indeed,
last year.
Indeed. So I wouldn't touch diamonds, but allocation to gold, whether it's the sovereign bonds or some other form of gold, but what would your asset allocation be at this juncture?
So each one to his course or her
What would you
course.
recommend?
I'll say in duration, try to, in fixed income, go longer duration. And maybe next month or so when US yields are rising, you'll get a good opportunity to invest. On gold and silver, we still believe it's time to be overweight despite this run-up. Of course, there will be ups and downs in gold and silver, but eventually, if central banks of the world are becoming like Indian housewife, buying gold and never selling, gold prices has no option but to go up. In silver, supply is getting restricted and demand is very strong.
Yeah.
So those prices also remain supported. And on equity also, maintain your neutral allocation to equity. It's not a market to be leveraged or over-invested, but at the same time, don't become underweight because they have corrected in last few days. It's time to maintain asset allocation as per your risk profile and be honest to yourself. If you bought during COVID time, that means you are a risk taker. If you sold during COVID time, then you're a conservative guy. And if you didn't do anything and just let your SIP continue, then you are average risk taker. Don't be dishonest with you.
Naren is a big believer in asset allocation, and you've been saying, right, you've been saying flexible funds, funds which allow you to kind of move freely between various asset classes. That's the way to go still?
Yeah. But today, the challenges at this point of time, which are the places where there's fear? Globally, there's fear in office assets. So that's why we like if somebody, because anything to do with offices have gone down substantially globally because of this work from home. So that's one area of fear. But otherwise, across asset classes, there isn't fear. Your 10-year yield in India is possibly much lower than gold, silver have gone up. Everything has, residential real estate has gone up. So one of the challenges at this point of time, there are no pockets of deep value at this point of time within India. I mean, if you find a way to invest in some other countries like Brazil, market hasn't gone up for 10 years. So they must be having their problems. But I'm just saying that at this point of time, there are not too many asset classes with fear at this point of time.
Let's bring in Nimesh as well.
So
Nimesh.
I want to ask both the gentlemen, something which is close to your heart. I'll start with Naren first. We've always seen you, heard you as a Contra investor. And whenever I've heard you or I've met you, you always given one or two Contra ideas. From this Diwali to next Diwali, if I want to ask you, if you want to stick your neck out, what could be your Contra bet? Whether it's a sector bet or a asset allocation bet, what would be your top pick?
So actually, what we've done is that we've certainly seen banks as a bet. So if you look at some of the strategies that we run, we have much higher banks than we ever had, private banks than we ever had. So I would certainly see that. And certainly we have more cash in our funds than we had. So if you look at because we went through a debate, can we have cash? And we said cash can be, it involves risk. I don't think the cash in the portfolio is low risk because finally you're comparing yourself against a benchmark. So I would say that we did have cash. It doesn't mean that we are negative. It means that we said that what could be Contra at this point of time? Can you show me something which is Contra? I couldn't find. So we said, let's have some more cash.
So bank and cash is your Contra bet for next year?
At this point of
cash in the bank.
But cash. And so that's why, my colleague in the company said, let's look at where people are not willing to invest from outside. They said offices. So that was one area. Sure. So we keep thinking what can be, but it's been such a difficult task to identify contrarian assets in the financial space at this point of time.
That's a statement from Naren. Nilesh bhai, whenever we've met you and we've had you on the channel, you've left us with some headline. I'm just looking for one big headline from this Diwali to the next Diwali. What could be that one headline from Nilesh Shah?
पिछली दिवाली से इस दिवाली गधे और घोड़े दोनों दौड़े and गधे ran faster than horses. इस दिवाली से अगली दिवाली घोड़े दौड़ेंगे गधे नहीं दौड़ेंगे.
That's a big one.
That is what I love about Nilesh Shah. He'll always have a nice punchline ready for us.
Put it quality over non-quality.
Quality, yeah.
Quality over non-quality is something I fully accept.
And I think it started visible, right? We saw momentum losing out, the value losing out. The PSU index is down 12%. Stocks are down 40-50%. The mid-cap and small-cap have started giving up. And what's working is, as you rightly pointed out, banks and especially banks per se, the numbers also not been that bad.
But
so
if you look
looks
at,
like that shift is
if you
happening.
look at FMCG kind of sectors are also some things which we have started to look for from a contrarian angle because some of those stocks have not delivered now for 4 years.
Absolutely. Yeah.
At this point of time.
But talking about PSUs, select names you have been positive on, and the index itself has corrected a whole lot. Do you still think there are themes out there? Because the entire market capitalization went from 15 lakh to, I think, 80 lakh crore. And then from there, we saw that correction.
But we lost enthusiasm in PSU as a theme some time back. Because as Nilesh pointed out, the most illiquid PSU started to go up substantially. So that's why, we've not been talking too much. In fact, if you look at our portfolios, I would say they were managed very well. And that's the reason we made money in them. But they're no longer as attractive as it was. And thanks to the good work done by many of the PSU managements, along with the government. So if you look at it, their dividend yields are better, their balance sheets are better, they've not done stupid things. So everything has been good. But due to that, as a contrarian, I would say I was forced to sell them.
In fact, we have gone to the government and said, please do divestment and raise money. This is the best time to get your value.
Absolutely.
I'm glad you brought up that point because that's just the one thought that I wanted from both of you. This has also been the year where we've seen a massive amount of paper come into the market, right? IPO, secondary sales, promoters selling, blocks. Nimesh is our, blocking. He tells us ahead of everyone else in the market, right? And it is more often than not that Indian mutual funds have participated. Some can argue they're giving exit to a lot of these insiders or foreign investors. But what are your thoughts on the quality of paper that's come in, the fact that a $3.3 billion IPO gets subscribed? And will you all perhaps still show that kind of appetite for the paper that's lined up ahead? What will the next Samvat be like for just the supply of paper and your appetite for it?
So one, SEBI has done a great job in ensuring that there is enough disclosure. And it's not that all issues have gone through. One very colorful issue didn't go through, last year. So it's not that every issue and every Tom, Dick and Harry is getting sold. People are using their judgment. And undoubtedly, thanks to SEBI, quality as well as disclosure both has improved significantly. It's not like 1991 where you will see not companies, sectors disappearing, aquaculture, bulk drugs, granite companies, NBFC, telecom companies, media companies, technology companies. Entire sector disappeared. That's not the case today.
Okay. Naren, you want to add to that?
I think, no, we have to be much more careful in investing now. I think the seller knows a lot. And sometimes the seller is offering because they are able to see that it is fully valued. And so I think the easy phase where you're going to make money by investing in IPOs or QIP is over. So actually we think that we have to do much more work. And it's nothing to do with the regulator. The regulators tightened processes. So I think we have to do the right work. I think in between what happened, people could make money in anything too easily.
Yeah.
So then people just bid up the prices. Now actually we should see some failures. That will help the system actually. Then people...
Some deferments.
Then after that, people will come back to fair value. And then it will help us.
Okay, I think Pashupati has a question.
Yes, we have Pashupati as well. Sir, you've seen so many Diwalis. Your take on what to watch out for?
I think I'm the oldest person in the room. But I just want to circle back to one topic that Naren, you mentioned, the election in the US. How do you think the market will perform with Trump in the White House versus Kamala Harris in the White House going forward? And then maybe Nilesh wants to offer his thoughts.
I think not enough work has been done on it. But the belief is that Trump in the White House means that yields go up and US equities does well, and everywhere else in the world equities does badly. This is the belief at this point of time. And Trump is known as a negotiator. So, this is the initial belief. Then how he negotiates things, like people believe that China has not announced the full stimulus primarily because they are waiting for the results of the US election. So I believe that there is going to be much more volatility, and what people haven't understood is in the last 4 to 8 years, slowly the US macro indicators are much weaker, like fiscal, current account, and therefore I think they have not even managed to bring down inflation to the level that it should have come down to. So I think we are headed for a volatile period because of US policy.
Nilesh, you want to offer any thoughts?
Prashant,
No expertise on US. I can barely understand Indian politics. Where will I have time to study
you want
US
to offer
politics?
Any thoughts on, you got elections here as well?
elections.
An important state election, Nilesh.
So from a market point of view, it is the federal election which matters. And many a times we have seen that to win election, people say one thing, and when they form government, they do other thing. So the real challenge for me is that today there are few things which we are doing in coalition government. For example, infrastructure spending, digitization, skilling, housing, fiscal prudence we have maintained. This is all good. This will support growth. But we are still not taking tough decisions on land reform, labor reform, farm reform, judicial reform, GST rationalization. We went backwards on pension. Now, all these things over a period of time will have impact on our growth. I have to hope and pray that the things which I am doing on infrastructure, digitization is so good that it carries my momentum forward. But I'll be at some point of time worried that the reforms which we are not doing on land, labor,
That will start to weigh.
Those will have implications on our growth.
I think, please go ahead.
Yeah, I have a question on the category-wise flows. So what we've seen is in the last 12 months at least, most of the flows are going towards mid and small. Like I would say, like the large cap category has seen like 3 to 4% of the category flows. So it is kind of got a little bit out of fashion, like large caps in the last, especially 4 or 5 years. So what do you think would be the message to investors to look at the large cap space? Because as we know, like these are cyclicals, like the caps move in cycles over the last like many years. We've seen that. So what would be your advice on this space? Thanks.
My view is that while that is true of mutual fund flows, I think EPFO flows, NPS flows, they're all coming in large cap. So I think that balance is there. I would worry a lot if EPFO and NPS kind of flows start going into mid caps and small caps. So actually there's a good balance that actually NPS and EPFO flows are actually 100% large cap and they're not small caps. So I believe that as long as they don't suddenly say, okay, if I had invested in small cap, I would get very big, higher returns, then they'll be choosing the wrong time to do it. So that's why I would say that the balance is there. Then so many schemes, so many MCs have closed down lump sum, and some of them accept only SIPs. So I think things are in between. The regulator did a lot of work on this issue. So I think things have been reasonably balanced now. And I think 6 months back, we used to be more worried about it. I think now the issue is it's been a much more balanced market in the last 6 months.
Okay, I think that's a nice way to wrap up this very special program as well. The Samvat Baitak, as we were calling it. Nilesh bhai and Naren, thank you so much for joining us. Happy Diwali.
Happy Diwali.
To both of you, your families, and of course everyone. And thank you all for being here with us on this special program. Well, thank you for watching. Thank you for staying with us. Happy sort of Diwali, happy festive wishes to all of you, your families, and more programming on the other side of this break.